afternoon, everybody. Thanks for having me. And thank you for Tata Group for bringing me all the way down from the United States. I'm happy to be here. I'm jet lagged like you would not believe, but I love coming to other countries to meet other investors from other countries. Because when you meet investors from other countries, I think you realize that we are all playing the same game. And we have similar goals, and we're dealing with similar emotions, but we've had vastly different experiences. And what I've experienced as an investor in the United States is totally different from what you have experienced as an investor in India. And because of that, I think there's a lot that we can learn from each other. And so I want to start today with the story of two investors in the United States, neither of whom knew each other, but whose paths crossed in an interesting way a few years ago. The first is an investor named Grace Groner. Grace Groner was born in 1910 just outside of Chicago, and she had kind of a hard life. She was orphaned as a child. She never married. She never had kids. She never drove a car. She wore used clothes, lived in a one-room house for most of her life, worked as a secretary for her entire career. She was, by all accounts, a lovely lady, but she had just kind of a hard, humble life. And Grace Groner died in 2010. She was 100 years old. And when she died, everyone who knew her was shocked to learn that she left $7 million to charity. And everyone who knew her said, "Where did Grace, this humble orphaned secretary, get $7 million?" And they started digging through her papers, digging through her accounts, and they realized there was no inheritance, there was no lottery winnings. Basically, she took what little she could save from her job as a secretary, she invested it in the stock market, and she let it compound for 80 years. And that was it. That was the end of her story. The second investor I want to talk about is a guy named Richard. I'll leave out his last name. But Richard had almost the exact opposite upbringing as Grace Groner. He was born into a very wealthy family, went to Harvard University, got his MBA from Harvard Business School, went to work on Wall Street in the 1980s, and truly became one of the most powerful men in global finance. He was a vice chairman of Merrill Lynch during the 1990s. He retired in his early 40s to pursue charitable activities. 2 weeks after Grace Groner died, Richard filed for personal bankruptcy. He told the bankruptcy judge that the financial crisis in 2008 completely wiped him out, so much so that his only source of money to buy food for his family was selling the furniture out of his house. And what I think is interesting about these two stories together is that there's no other industry where stories like that are even possible. There's no other industry in the world where someone with no education, no background, no experience vastly outperforms someone with the best background, the best education, the best experience. It just never happened. It's impossible to think of Grace Groner performing open heart surgery better than a Harvard-trained cardiologist. There's no chance of that ever happening. But those kind of stories happen in investing. And what that shows, I think, is that investing is not necessarily about what you know. It's about how you behave. And behavior is very hard to teach, even to really smart people. Since it's not analytical, we can't sum it up into formulas that people can memorize. You can't plug it into a spreadsheet that gives you an answer. It's kind of just this soft, mushy topic that often gets swept under the rug when people are learning about investing. So what do we do about that? What I want to do today is share the learning method that I've seen a lot of investors use to kind of wrap their head around the messy concept of behavioral finance. Back at home, I have a friend named Patrick O'Shaughnessy. He's a great investor, and he has a book club, private book club that he shares with his friends, book recommendations and book reviews. And he sent around an email to his book club about 2 years ago. The subject line of the email was the best investing books of 2016. And the first sentence of the email said something really interesting. It said, quote, "Since it is more productive to read around one's field rather than in one's field, there are no investing books on this list." And this, I think, is actually a very effective form of thinking, because investing is not just the study of finance. It's a study of how people behave with money. And since it's a study of behavior, it incorporates the lessons and the rules from all kinds of other fields that are also the study of behavior, like psychology, politics, sociology, history. All of these fields that we think of as standalone fields, but they all kind of fit under this umbrella of how do people think about risk? How do people deal with uncertainty? How do they deal with opportunity? And that's all investing is. So what I want to do today is share 5 stories, none of which have anything to do with investing, but all of them, I think you'll see, have a pretty clear takeaway about how people think about risk and how we as investors can deal with risk in a more productive way. The first story I want to talk about is what nuclear energy teaches us about investing. The peaceful use of nuclear energy really took off in the early 1970s. And it's hard to overstate how important this was at the time, because nuclear energy promised to solve one of the biggest problems of human history, which was securing abundant energy irrespective of your country's natural resources. So virtually every developed nation in the early 1970s was pursuing nuclear energy. And one of those countries was Austria. The Austrian government came together in 1972 and they said, we're ready to build our first nuclear power plant. And this is what they built. This is the Zweltendorf nuclear power plant just outside of Vienna. It took 2 or 3 years to build it, cost about $1 billion to build it. And when it was complete, it had the capacity to supply 10% of Austria's energy, which was massive for one power plant. Now, after they finished it and just before they turned the power plant on, there were some newspapers in Austria that started publishing a ton of content, articles and editorials about the risks of nuclear energy and what a nuclear meltdown would do to society, how much risk it would cause to the local population. And they really doubled down on presenting this as a big risk to Austrians, so much so that there were so many protests right before Zweltendorf was turned on, that in 1976, the Austrian government held a referendum that said simply, we have this nuclear power plant, do you want to turn it on? And the people voted no. And that's held through today. Zweltendorf has never produced a single watt of energy. It's used as a training facility for German engineers. And what I think is interesting about this is that at the very same time this was going on, the UK and the United States and Germany and Switzerland and France were all building and enthusiastically using nuclear energy. India was building and enthusiastically using nuclear power plants. Japan, which understood the risk of nuclear energy better than anyone else in the world, was building and enthusiastically using nuclear power plants. And the Austrians had the same engineers as everyone else. They had the same data as everyone else. They were building the same power plants with the same safety mechanisms as everyone else. But while the rest of the world came together and said, this is worth the risk, the Austrians came together and said, absolutely not. It's so not worth the risk that don't even turn on the one that we already built. And what that shows, I think, is that when people think about risk, they don't always do it in an analytical way. They do it in a cultural way. And what people think is risky is heavily tied to the country that they were born into, the generation that they were born into, the values that were taught to you by your parents and your teachers. All of these things are not only completely out of your control, but they vary wildly from person to person and country to country, generation to generation. People want to think that risk is a force of nature that applies to everyone indiscriminately, and it is. But that's not how people actually think about risk in their own life. Whatever we think is risky is heavily tied to our own personal past, our own unique personal past. And that is also true in investing. This I want to show you is what the US stock market did during your teens and 20s, your young, impressionable teens and 20s, when you're learning a base of knowledge about how the economy works that's likely to stick with you for the rest of your life. If you were born in 1970, the US stock market went up tenfold in your teens and 20s. It's a great return. That's after inflation as well. If you were born in 1950 in the United States, the market went nowhere in your teens and 20s after inflation. Zero return. Do you think these two generations went through the rest of their life thinking the same thing about the stock market? That it posed the same risk to you as an investor? Or that it was capable of the same returns to you as an investor? Of course not. This stuck with them for the rest of their life. And this is true for something like inflation as well. In the United States, if you were growing up in the 1970s, inflation averaged about 8% per year. If you grew up in the 2000s, like I did, inflation averaged about 2% per year. And in the 1930s, during our Great Depression, it was negative 2% per year. We had deflation. So I would ask again, do you think these generations went through the rest of their life thinking the same thing about inflation? Absolutely not. And we saw this in the last decade in the United States when gold as an investment became very popular as our central bank was printing a lot of money. But what generation do you think gold was most popular with, most appealing to during this time? It wasn't my generation, who's never experienced inflation. It was my parents' generation, who came of age in the 70s when inflation was very high. I was recently in Australia, where they haven't had a recession in 27 years. Whereas we in the United States have had 3 recessions in the last 27 years, 2 of which were devastating, reshaped our culture. Down in Australia, they just have a very different view about the risk of recessions than we do. And what I think is important is that it is possible that the Australians are complacent about the risk of recession based off of their history. But I think it's equally possible that we, as Americans, are overly paranoid about the risk of recessions based off of our experience. I don't think you can say that one group is smarter or better prepared than another. I think all you can say is that we've had vastly different experiences in the world, and that shapes how we think about risk in totally different ways. Now, about a decade ago, a group of researchers from Stanford University crunched a bunch of data to show how does this actually impact investors in real time. And they looked at a bunch of brokerage account surveys going back, I think, 50 or 60 years. And what they found was if you grew up during the Great Depression, you were half as likely to invest in stocks compared to those who grew up in the 1960s when the economy was strong. If you grew up in the 1970s when inflation was very high, you were a third as likely to invest in bonds later in your life compared to those who grew up in the 1950s when inflation was low. And if you grew up during the 1980s when the economy was strong, you were twice as likely to buy stocks later in your life compared to those who grew up in the 1970s. And their grand conclusion when they put all this data together was, quote, "Our findings suggest that individual investors' willingness to bear risk depends on their personal history." Now, a few years ago, I interviewed Dr. Daniel Kahneman. Kahneman is a psychologist who won the Nobel Prize in economics for his work in behavioral finance. And we talked about this idea that people's past shapes how they think about risk. And he had some interesting views on this topic. Here's what he had to say.
If I have problems remembering the past and I'm fooling myself, how does that shape my view of the future?
The main mistake that people make, it's not so much in remembering the past, it's in thinking about the past. Whenever something happens, and we feel we understand it, we're surprised occasionally, but by and large, the world makes a lot of sense to us. And it makes a lot of sense because when things happen, we find their causes, and it's okay. Except that if you compare our ability to explain the past with our ability to forecast the future, the difference is really quite dramatic. I mean, we explain the past with the greatest of ease, and we're really crummy at forecasting the future. Hindsight, the ability to explain the past, gives us the illusion that the world is understandable. It gives us the illusion that, the world makes sense, even when it doesn't make sense. That's a big deal in producing mistakes in many fields.
Now, later during this talk, Kahneman kind of explained how this idea applies to him personally. He mentioned at one point that he's the biggest pessimist he's ever met. He said, no one is more pessimistic just on the outlook of humanity than he is. And we said, wow, that's fascinating. Is that because you have all of this knowledge about the behavioral flaws that go on inside of our head? And he said, no. He said, everyone in his family is a pessimist. And he started talking about his upbringing in Nazi-occupied France and how it taught him and his family from an early age how complicated and sometimes evil people can be. And that's obviously not an experience that I had. And it's an experience that I don't think anyone in this room had. But that was his life. And it shaped how he thought about risk for the rest of his life. And that's an extreme example, but I think we all have something like that. Whenever we're thinking about risk, we all just become prisoners to our own personal past. And so we asked Kahneman, what can we do about this as investors? And he had 3 things to keep in mind. The first was talk to as many different people as you can. I think in particular people from different generations and different countries who've had totally different experiences than you have. Often like we're doing at conferences like this. What you will gain from that by meeting different people who had different experiences is you will just broaden the range of horizons in your head of potential outcomes that you might experience during your lifetime as an investor. His second point was talk to people who you disagree with. Confirmation bias, where you're only going to seek information from people who are like you and who agree with you, is very prevalent in politics. It's also very prevalent in investing. And Kahneman's point was, if you have a view about where the economy is going to go next, or what the stock market is going to go next, it is incumbent on you to be able to explain the opposing side's view as well as they can. Because very often what happens when you meet someone who disagrees with you, the natural reaction is to think that person is not as smart as you, or they don't have as much information as you, when very often they do, but they just have a very different view on the world based off of their own experiences. And by trying to put yourself in their shoes, you are again broadening your horizons of the scope of possibilities that you might experience as an investor. And his third point was talk to people who are in different emotional states than you are. Managing money is very emotional, whether you are a professional investor or an individual investor. And Kahneman's point was mainly for financial advisors. Your main job, one of your most important jobs as a financial advisor, is to be able to look at your client's financial situation without all the emotional baggage that they themselves bring to the table when thinking about money. So that's the first story I want to talk about today. The second story is what the war on cancer teaches us about investing. The war on cancer in the United States really took off in the early 1970s. And if you go back to that era in the early 1970s, there was a big boost of scientific optimism. We had just landed on the moon. We had made big strides in wiping out polio. And there was just a general sense during this time that if we put our heads together, we can solve any scientific problem, no matter how hard it looks. National Cancer Act was signed in 1972, and that just began a big surge in scientific funding for cancer treatment, cancer research. And this is what's happened since. These are the age-adjusted cancer mortality rates in the United States. And you can see that most of them are down, and they're down by a lot in the last 30 or 40 years. And even lung cancer, which is the one that's rising for most of the time, is now falling. I just saw in the Wall Street Journal just this morning that in the last, I think it was 15 years, the number of cancer deaths worldwide has declined by more than 25%. So the war on cancer has been a big success at saving and extending tens of millions of lives. But about a decade ago, the director of the National Cancer Institute in the United States, his name is Harold Varmus, gave a speech at the annual meeting of the National Cancer Institute where he said, look, despite this progress that we've made, we need to come to terms with an inconvenient fact. And that is, despite this progress, we have not been able to cure cancer like we once thought possible. And we might not ever cure cancer like we once thought possible. It's just turned out to be a much more complicated illness than we ever imagined. And if you accept that hard reality, then what the cancer community needed to do was open up a new front in the war on cancer, and that was prevention. Because we know that in the developed world, about half of all cancers can be directly tied to lifestyle, mainly diet and smoking. And so if we couldn't cure cancer, what we had to do was just make sure that people never got cancer to begin with. That was how we were going to make the next leg down in these numbers. And what's happened since has been very interesting, which is despite knowing how important cancer prevention is, it's very difficult to get a lot of doctors to take prevention seriously. It's very difficult to get politicians to take it seriously. It's extremely difficult to raise money for cancer prevention relative to how much money you can raise for cancer treatment. And about 5 years ago, one of the top cancer researchers in the world, his name is Robert Weinberg, gave a talk about why he thinks this is, why it is that cancer prevention is so important, but it's so difficult for the cancer community to take seriously. And what he said was, quote, if you don't get cancer, you are not going to die from it. That is a simple truth that we overlook because it is intellectually not very stimulating. He went on to say, quote, getting someone to quit smoking is a behavioral exercise. It has nothing to do with cells and molecules, so people like me are essentially uninterested in it, in spite of the fact that getting someone to quit smoking will have vastly greater impact on cancer mortality than anything I can hope to achieve in my own lifetime. So here you have one of the top cancer researchers in the world who's saying, I can make a bigger difference doing something else, but it's just not very exciting. It's not intellectually stimulating, so we don't pay any attention to it. And of course, we could say we don't want people like Robert Weinberg trying to get people to quit smoking. He's a molecular biologist. He adds value in his own way. But there is this irony in the war on cancer, which is that things that are very effective, but very simple, very basic, are not taken as seriously as other things that are very complicated, but knowingly less effective. And that is also true in investing. We know the simple formula that you need to use to succeed in the stock market. It's not very complicated. All you have to do is spend less money than you make, save the difference, buy a diverse portfolio of great companies, and be patient. It's effectively 90% of what you need to know to do well in the stock market over time. But do you think this is how investing is taught in schools to professional investors? I have a college finance textbook left over. There's a chapter in the textbook called The Assessment of Confidence Limits of Selected Values of Complex Valued Models. And this formula is in there. And look, this side of the chart, this is the diet and exercise side of investing. Very simple, very basic, but very effective. And this is the, mapping the genome side of it. Very complicated. And it's not that it's bad, it can be very useful. But we know it's less effective than this side, even though all of the intellectual stamina, all of the attention in the industry goes to the other side when this side is more important. This I want to show you, this is Warren Buffett's office in Omaha, Nebraska. He's worked in this office for more than 60 years. This is the desk where he became the greatest investor of all time. And I just want you to see how simple and basic it is. There's no TVs, there's no computers, there's no ticker tape, there's no analyst shouting into his ears. It's just a desk and some books and a chair, picture of his dad behind his shoulder. I don't know if you can see up front, there's a bin down here. It says too hard on the bin. When it comes across a problem that's too hard, you put it in the too hard bin and move on. It's just as simple and basic as it can get. This is the mortgage trading desk at Lehman Brothers right before they went bankrupt in 2008. Guy has 8 monitors. What is he looking at that is so important that needs 8 monitors? Poor guy next to him only has 3 or 4 monitors. But look, I'd say if you are a young person coming out of college and you're looking for an exciting career in finance, what looks more interesting to you, this or this? Or if you are a fund manager trying to prove to your clients that you are smart and you add value, what do you want to show them? This or this? It's obvious where the intellectual attention goes to in the industry, even though the irony that everyone knows is these people went bankrupt, and this is the greatest investor of all time. Now, speaking of Berkshire Hathaway, there was a 20 or 25-year period where the average private equity fund returned about 14% per annum, while Berkshire Hathaway returned almost 19% per annum. So this annual outperformance, 5 percentage points of outperformance over its benchmark, is what made Berkshire Hathaway one of the greatest investors of all time. If you go on Amazon, there are 2,000 books that are devoted to how this happened. How was Buffett able to achieve these returns? And they go into in depth about how he thinks about valuations, how he sizes up management teams. And a lot of them are great books. But here's one thing I want you to think about. The average private equity fund is charging 2 and 20 as a fee structure, 2% of assets and 20% of all the profits on top of that. Berkshire Hathaway charges no fees whatsoever. Just that one fact alone, just that the private equity funds are charging 2 and 20 and Berkshire's charging 0, just that one fact alone accounts for 4 percentage points of the outperformance. Now, how many of those 2,000 books do you think mention this? I've never seen it mentioned anywhere. And I think the reason is that it's just too simple an explanation for people to take seriously. Most people don't want to accept that how do you explain the performance of the greatest investor of all time? Honestly, you can explain most of it by just saying he's a pretty good private equity fund investor who doesn't charge fees. I think people just don't want to take it that seriously, even though if we know that mathematically it's correct. About 10 years ago, someone asked Charlie Munger. Munger is Buffett's longtime business partner. A journalist asked, in a sarcastic way, they said, Mr. Munger, if Berkshire's strategy is so simple, why haven't more people copied it? And Munger said, quote, more investors don't copy our model because our model is too simple. Most people believe you can't be an expert if it's too simple. He went on to say, quote, how did Berkshire's track record happen? If you were an observer, you would see that Warren did most of it by sitting on his ass and reading. Simple as it gets. My favorite example of all this, there is a famous US economist named Harry Markowitz. Harry Markowitz won the Nobel Prize in economics in the early 1990s for his work on the efficient frontier, which is a very mathematically complex set of theories and formulas that will tell you exactly what percentage of your assets should be in cash versus bonds based on how much risk you want to take. It's It's a very complicated set of formulas. It took him almost his entire career to develop this formula, and he won the Nobel Prize for it. And a few years ago, the Wall Street Journal did an interview with Harry Markowitz, and they said, Dr. Markowitz, you won the Nobel Prize for these formulas. How do you use them to invest your own money? And Harry Markowitz said, quote, I visualized my grief if the market went way down and I was completely in it, or if it went way up and I wasn't in it. So I split my contributions 50-50 between stocks and bonds. I mean, this is the guy who won the Nobel Prize for this formula. And for his own money, he didn't even use it. And what I think that shows is that something like the efficient frontier is useful because it is intellectually stimulating for very smart people in academia. But in the real world, even for their own money, it doesn't have a lot of practical uses. What works in the real world, even for their own money, is very simple and basic rules of thumb, often based around things like behaviors. I think the best investing advice that anyone can take for themselves or give to someone else is take a simple idea and take it seriously. There's so much evidence that we intuitively think that a complicated investment idea is going to outperform a basic investing idea. And there's equally as much evidence that that idea is wrong. We often have to remind ourselves that the goal of investing is not to minimize boredom, it's to maximize returns. And we learned after the financial crisis in the United States, when there was a crisis of trust in the financial industry, that a lot of clients have a hard time distinguishing between their confusion and their advisor's intentional obfuscation. And when they came across something that they did not understand, they were much more likely to say, I don't know what this is, I don't get it, I don't know if I trust you anymore, and so I want out. And if you want your advisor or your clients to stick around for years and decades, they have to be able to explain they have to be able to understand what they're invested in and why they're investing in it in the simplest ways possible. Because there is no investment recommendation that is worth the paper it is written on if you or your clients are likely to abandon it at the first sign of confusion. The third story I want to talk about today is what baby brain development teaches us about investing. The amount of growth that goes on inside a baby's brain after they're born is just extraordinary. An average baby is born with about 100 billion neurons in their brain, and each one of those neurons has about 2,000 synaptic connections to other neurons that form this web of knowledge in the brain. It might look something like this when they're born. By 6 months old, that's increased to about 6,000 synaptic connections in their brain. So the web is just getting much more complicated and complex. By 2 years old, that's increased to more than 15,000 synaptic connections in their brain. So in the first 2 years, just an extraordinary amount of growth going on inside their brain. But then something pretty interesting happens, which is after about 2 years old, the number of synaptic connections, the complexity in your brain, not only plateaus, it starts to decline, and decline fairly rapidly. By age 4, the average child has lost about 1/5 of their synaptic connections. By age 6, they've lost about 1/3 of their synaptic connections. And this continues on throughout childhood, on into adolescence and early adulthood. By age 20, the average person has lost almost half of the complexity in their brain. Why does this happen? It turns out that a lot of the learning that goes on inside your brain in your first 2 years of life is very inefficient, or it's redundant, or it's just wrong. There's evidence that there are some newborn babies can smell colors, and hear smells, because the part of your brain that's processing this information is just completely miswired. And so you go through part of your life getting rid of these bad, inefficient, and unnecessary connections in your brain. And what's important about this is that even when what's going on inside a child's brain is loss and chaos and destruction, they're getting smarter. A 4-year-old is much smarter than a 2-year-old. A 20-year-old is much smarter than a 4-year-old. Mostly. There are exceptions. And this idea that you can go through loss and chaos and destruction while growing and getting smarter and improving is a really important idea because we see it in many fields. And one of the fields we see it in a lot is in investing. We have an index in the United States called the Russell 3000. It's an index of 3,000 large cap companies in the US. This is how it's performed over the past 35 years or so. It's done pretty well. There's a lot of volatility, but it's returned, I think, more than 10% per year during this time. A great return during this period. What's interesting is that if you look at how these individual 3,000 companies performed. Not the overall index, but if you dig into the individual components in this index, how did they do over this 35-year period? You get some interesting data. You'll find that the median stock of these 3,000 companies underperformed the average by 54 percentage points. 40% of companies in this index lost money over a 35-year period. Almost half the companies during this period lost money. A lot of them completely went out of business. Virtually all of the return during this period came from 7% of companies that did extraordinarily well. So here again, you start with an index that's done really well over time. This is great. And then you look at what's going on inside, and it's chaos and loss and destruction. And now imagine if you were a parent and you could look inside your child's brain and see that every day that they woke up after age 2, their brain was losing synaptic connections, was getting less complex over time. You would panic. And you would say, this doesn't seem right. This seems wrong. My child must be broken. I need to do something different. When in reality, it's perfectly normal. It's a perfectly normal part of how we develop over time. And as investors, we, I think, unfortunately, can do that with our portfolios. If we own a broad-based portfolio of companies, let's say 20, 30, 100 companies, whatever, a diversified portfolio, we're constantly bombarded with companies that are missing earnings, maybe even going out of business, performing very poorly. And even though that's a perfectly normal part of diversified investing, it can cause us to take behaviors that we might eventually regret over time, even though it's a perfectly normal part of diversified investing. And this also has a big impact on how we think about market volatility over time as well. This I want to show you, I think this is some of the most interesting statistics I've seen in investing. From 1995 to 2015, the S&P 500 returned about 8% per year. The average US equity investor during this period earned almost half that amount. For returns that actually accrued to the brokerage account, earned 4.7% per year. Why does that happen? You have a period where the market does very well, and the average investor does almost half as well. Some of that is fees. That explains part of the difference in this gap here, but that's not a very big percentage of it. By far, the biggest reason why this happens is because the average investor during this 20-year period is buying and selling at the worst possible times. What they're doing, rather than just being a patient long-term investor, they're engaging in behavior that was best portrayed by Carl Richards of the New York Times when he made this sketch where it says, greed buy, fear sell, and repeat until broke. And so much of where this comes from is just how we think about market volatility over time. This is the S&P 500 since 1950 through 2018. And this is about as good as it gets in the United States. I think the market went up about 10% per year during this period. Over 60 years or so, it's enough to increase your money 200-fold during this period. If we can repeat this performance over the next 60 years, that's as much as we could ever hope for. This is really about as good as it gets for a country like the United States. But this I want to show you, this is when the market was down 5% from its previous all-time high. This is when it's down 10% from its previous all-time high. And that's when it's down 20% or more from its previous all-time high. So you start with the picture of success, as good as it gets, and then you look at the nuance of what went on inside of it during that period, and you get something totally different. And what's important is that at every one of these bars here, you had investors all around the world saying, this feels wrong, this feels broken, I don't like this, so I want out, and I'm going to sell. And they do it with good intentions. They're trying to make themselves safer. But what they're actually end up doing is pulling themselves away from a long-term investing strategy that's likely to earn the highest returns. One of my favorite quotes is from Dwight Eisenhower, a famous general and president in the United States. Someone was asked him, what is the definition of a military genius? And Dwight Eisenhower said, a military genius is the man who can do the average thing when everyone else around him is losing his mind. And I've always thought investing is pretty much the same. Successful investing is not necessarily about making good decisions. It's about consistently avoiding mistakes, consistently not screwing up, and responding to what's going on in the short run, the chaos and the loss and destruction in the short run, responding in a way that's going to pull you away from a long-term investing strategy that's likely to earn the highest returns. The fourth story I want to talk about today is what running teaches us about investing. About 100 years ago, there was a physiologist named Archibald Hill. He was a brilliant physiologist, one of the greatest of his time, before or since. And Hill viewed the human body that he studied as a machine, something similar to like a car that's governed by pipes and pistons and pulleys that you can measure with precision. Hill once said, quote, "Our bodies are machines whose energy expenditures can be closely measured." And Hill was a great athlete himself. He was a big runner. And he devoted most of his career to answering the question, how fast can people run? Given your body, given my body, what is the fastest that I could run 1 mile? What's the most I could take? What's the fastest you could run 1 mile? Hill devised a series of tests where he could bring athletes into his laboratory and measure their bodies, measure things like how much oxygen they could intake, how that oxygen was dispersed throughout their body, things like lactic acid build up in their legs. And he came up with a series of formulas that very accurately predicted how fast people could run. So much so that he could bring an athlete into his laboratory, measure their bodies, and then predict with very good precision how fast that athlete could run out on the test track. And these predictions were so accurate that Hill won the Nobel Prize in Medicine in 1922. And this caused a big buzz in the running community, because if you could predict who was going to win, or if you could predict how fast someone could run, you could predict who was going to win the next marathon. You could predict who was going to win the next Olympic gold medal, which is a pretty big deal. But there might be a reason that I think many of you have probably never heard of Archibald Hill, which is that those predictions, the ability to predict the next gold medalist, never happened. And it turned out that even though Hill's predictions were very accurate on the test track, they had almost no accuracy whatsoever on the racetrack. And Hill, to his credit, was not in denial about this. Someone once pointed out that his predictions were of no use at predicting race winners. And Hill said, quote, "To tell you the truth, we don't do it because it's useful, we do it because it's amusing." And this humility, I think, really caused him to try to figure out why this was. Why was it that he could predict an athlete's ability on the test track, but not on the race course? And he spent years trying to figure this out, and he worked with a lot of different scientists from other fields who eventually figured out what was going on. And that is, in a competitive race where the stakes are very high, people get nervous, they get anxious, they get hyper-focused, they get determined, all of which has a big impact on your athletic performance and is nearly impossible to replicate in the laboratory. If I tell you to go outside right now and run 1 mile as fast as you can, give it everything you've got, you might be able to run a mile in, let's say, 8 minutes. You might say, I gave it everything, that's as fast as I could do it. But then if I say, okay, if you can go back outside and run it in 7 minutes and 30 seconds, I'll give you $1 million, you'll find a way to do it. How fast you can run is not just a function of your body. It's a function of your body within the context of your in-the-moment psychology. Hill, in an interesting coincidence, was married to John Maynard Keynes' sister. And Keynes, a great economist, discovered for economies what Hill discovered for athletes, which is that economies and people are not machines. They have souls, they have feelings, they have emotions. And because of that, they often perform vastly different in the real world than we would ever expect them to perform in the laboratory or on the test track. Hill, to his credit, came around to this, and rather than viewing the human body as a machine, he eventually said, quote, "There's clearly more to running than sheer chemistry." Keynes called this animal spirits. Hill called it moral factors. I think both of them can just be summed up as there's a big difference between the real world and the classroom. And that's also true in investing. About 10 years ago, a group of researchers from Vanguard crunched a bunch of data, and they looked at a bunch of statistics and variables that investors like to look at. Things like GDP growth, interest rates, profit margins. And they wanted to see how do those variables that we can look at today correlate statistically with what the market does over the subsequent 3 years. What can we look at today that's going to tell us what the market is going to do next? And these are those correlations. You can see there's some things like the PE ratio that explain a decent amount of what's going to happen next in the market, but still a pretty small minority amount. And then there's all these other variables like corporate profit margins and interest rates and trend earnings growth that have literally zero statistical correlation to what the market is going to do next. They tell you nothing about what the market might do next. Someone clever at Vanguard included rainfall as one of the variables, just to be kind of fun and funny. And even rainfall has more correlation with what the market is going to do next than things like profit margins and earnings growth. Both tell you roughly nothing about what's going to happen next. And what this does to us as investors is it just makes it very difficult to predict what's going to happen next. Because there are all these other factors that are more important than all these variables, like people's emotions, people's relationship with greed and fear, that have a much bigger impact on what the market is going to do next and are very difficult, if not impossible, to preemptively measure. So again, it just makes it very difficult to predict what might happen next, even if you're looking at variables and statistics that intuitively seem like they should have a big influence over the stock market. Our stock market in the United States bottomed in March of 2009 after the financial crisis, and it proceeded to go virtually straight up, had a huge rally starting in March 2009. By November of that year, November of 2009, I think the market had already rallied about 30%. Barron's wrote an article, and the headline of the article was, "The easy money has been made." Which, if you're not familiar with it, is a quote that is very common in the United States. It basically says, anyone could have seen these gains up until now, but going forward, it's going to be very difficult to make money. The market kept rallying, kept going higher. 1 year later, this time Morningstar, they wrote an article called, "The easy money has been made." Market kept rallying, kept going straight up. 1 year later, 2011, this time MarketWatch, they warned, folks, the easy money has been made. 1 year later, 2012, market kept going higher. This time, TheStreet.com, they say, folks, the easy money has been made. There's like 6 more of these. It keeps going. And what I think is important here is that the people who wrote these articles are very smart people. And if you go back and read these articles, they make a lot of sense. They talk about things like our unemployment rate was very high, our budget deficits were very high, economic growth was very low during this period. All of which you would think intuitively should make it very hard for the market to keep going higher. But the market did go higher because there were other variables at play that were much harder to measure. Things like people were scared in 2009, and then they got in a better mood as the years went on. They got less scared over time, which had a big impact on valuation multiples, which drove market returns for most of the last decade. But how do you measure what kind of moods people are in? How do you measure how people's moods might change over the years? Very difficult to do. We know the simple formula that people need to use to know exactly what the stock market is going to do next. You only need to know 3 things. You need to know earnings growth, plus the dividend yield, plus or minus the change in valuation. If you know those 3 things, you know exactly what the stock market or any stock is going to do next. The dividend yield is easy. We can look at that number today. We know what that number is. Something like earnings growth, you can make a pretty good estimate of what it's likely to be in the future. But the change in valuation multiples is nearly impossible to know. Because all valuation multiples are a function of people's moods and emotions. When people are in a good mood, valuations are high. When they're in a bad mood and they're pessimistic, valuations are low. So if I'm an analyst trying to predict what the market's going to do over the next year, how could I possibly know what kind of mood people are going to be in 1 year from now? I don't even know what kind of mood I'm going to be in tonight. And this is why predicting what the market is going to do next is just so incredibly difficult. And this bothered me for a long time as an investor, because investing is a forward-looking endeavor. And if we don't know what's going to happen next, how are we supposed to make decisions? I came across this quote from Benjamin Graham, one of the greatest investors of all time, who said, quote, "The purpose of the margin of safety is to render the forecast unnecessary." Margin of safety, or just room for error in what you do, is, I think, the only way to navigate a world that is inherently difficult to predict. If you have room for error in your budget, your household budget, you don't need to know whether we're going to have a recession this year, because you're not relying on that forecast. If you have room for error in your valuation analysis when you're looking at a company, you don't need to know whether we're going to have a bear market this year. You're not relying on that forecast. Room for error, again, is the only way to navigate a world that is inherently difficult to predict. And I'll tell you something important about room for error. It is often associated, falsely I think, with conservatism, not taking a lot of risk, not wanting to take a lot of risk. I don't think that's right. I think what room for error does is it gives you or your clients the ability to endure future unknowns. And when you can endure future unknowns, you're giving yourself endurance. Compounding only works when you can give an asset years and years to grow. And the only way that you can survive during that period of time is if you can put up with all the unpredictable nonsense that's going to happen between now and then. There are investors who don't use room for error in their investing, in their investments, in their finances. And they might do better than you this year or next year. But they're much more likely to get wiped out or to give up when they come across something that they did not expect. And if you want to stick around for 5 or 10 or 20 years, by giving yourself room for error, you're giving yourself a fighting chance to be able to stick around for that long. That's when compounding works the best, and those are the investors who earn the highest returns. And the final story I want to talk about today is what the Wright brothers teach us about investing. Most of you will recognize this picture. This is the first second of the first flight in human history. December 17th, 1903, in Kitty Hawk in the United States. And it's hard to overstate how important this moment was because the airplane went on to change everything. It changed transportation, it changed politics, started world wars, ended world wars, completely upended communication and economies. I think if you had to make a list of the most important inventions of the 20th century, the airplane, I think in my mind, would probably be number one, at least top 3. It just changed everything. And what's interesting about the airplane is that you don't need any scientific background to understand how amazing this is. Unlike mapping the genome, where you need some scientific understanding to wrap your head around it, a child who was watching this moment could have realized how amazing this was. There's a man flying through the sky for the first time ever. It's amazing. It's going to change everything. So you can imagine how excited people got at this moment. And how people came together and said, now that we can fly, the world is never going to be the same. This is one of the biggest deals we've ever seen. How excited journalists became, running around writing about this moment that now we had built the airplane. Except that's not at all what happened after this moment. This is the front page of the New York Times on December 17th, 1903, the day the Wright brothers first flew. And it's small print, but you can take my word for it. There's not a single mention of the Wright brothers anywhere in the newspaper. The next day, December 18th, not a single mention anywhere. The 19th and the 20th, no mention whatsoever. By this time, the Wright brothers had flown more than 10 times. One of their flights lasted for 59 seconds, which was a long time for back then. No mention anywhere of what they were doing. About 2 years after the Wright brothers first flew, the New York Times did an interview with a German hot air balloon tycoon. And they asked this German hot air balloon tycoon if people would ever be able to fly. Would someone ever create an airplane? Let's see. There we go. And the German hot air balloon tycoon said, quote, in the very, very, very far future, there may be flying machines, but not now, not now. This was 2 years after the Wright brothers first flew. And in the largest newspaper in America, the people were still asking if anyone would ever be able to build an airplane. Because what actually happened was after the Wright brothers started flying airplanes, no one paid any attention to them. No one watched. No reporters came out to see, especially in big newspapers. There was, in fact, one newspaper that covered the Wright brothers' first flight. It was the Dayton Herald. The Wright brothers are from Dayton, Ohio. The Dayton Herald covered their first flight, and this is how they covered it. Dayton boys solve problem. I love how it's framed, just like a bunch of silly kids doing a science experiment that had no real significance. Now, years later, someone asked the editor of this newspaper, his name is Luther Beard. They said, Luther Beard, you are the only newspaper to cover the Wright brothers' first flight. Why did you do it? And Luther Beard said, quote, I used to chat with them, the Wright brothers, in a friendly way because I sort of felt sorry for them. They seemed like well-meaning, decent enough young men, and yet there they were wasting their time day after day on that ridiculous flying machine. The only newspaper in the world to cover the Wright brothers' first flight did it out of sympathy for some kids. Now, after Kitty Hawk, the Wright brothers went back to Dayton, Ohio, where they're from. And this is where they really mastered flying. They mastered the two most difficult parts, which are turning and landing. And Dayton is a pretty populated area. The Wright brothers were flying all around town. A biographer named David McCullough wrote a great biography of the Wright brothers, and he talks about this period when the Wright brothers went back to Dayton and were flying all over the town. And he writes, quote, not one reporter bothered to attend during this time, nor did public interest increase. With few exceptions, there seemed to be no public interest at all, no local excitement or curiosity or sense of wonder over the miraculous thing happening right in Dayton's own backyard. Now, of course, the Wright brothers got the credit that they deserved in due time, but it took years. It took them about 5 years to build the airplane and another 5 years recognition for it before people started paying attention to what they were doing. What's interesting about this period is that there were many teams that were trying to build an airplane during this time. Most of them just gave up. The Wright brothers were not the smartest. They did not have the most money. They weren't the best engineers. What they had going for them was just an amazing amount of patience to just keep plugging away at it. And when we think about entrepreneurs, the traits of entrepreneurs, we often think about things like ingenuity, creativity, your engineering ability. Rarely do we think about patience and time horizon as a competitive advantage. Or if we do, we often vastly underestimate how much time is actually needed for results to accrue in our favor. And that's also true in investing. This I want to show you, going back to the 1870s in the United States, is the maximum, the most, and the least you would have earned on an annual basis based on holding period. If you held stocks for 1 year or 5 years or 10 years, what's the most you could have earned on an annual basis and the least you could have earned on an annual basis for all the holding periods? And two things I think should stick out from this chart. One is that it scales down perfectly over time. So the longer you're holding stocks, the more likely you are to have a decent outcome, a pretty good outcome. Stocks become less risky over time for the longer that you hold them. But the other thing that I think should stick out is that it's not until 10 years, between 10 and 20 years, that every holding period has a positive return. Not a good return, just a positive return. We often have to remind ourselves in investing that when progress is measured generationally, results should not be measured quarterly. The single biggest issue that investors have with behavioral finance is underestimating the amount of time it's going to take for results to accrue in your favor. And if you ask most investors, are you a long-term investor? Most investors will say yes. And then if you ask them, what does long-term mean? What's the definition of long-term? They might say 1 year. 1 year is the long-term. Maybe they'll say 3 or 5 years. That's the long-term. Maybe they'll say 10 years. That's the really long-term. Historically, we know it's at least 10, if not 20 years. That counts as a reasonable definition of what long-term is. Just putting every holding period finishing with a positive return. It takes at least 10 or 20 years historically for every holding period to do that. And if you're giving yourself less time than that, you are, as an investor, relying on a greater degree of luck to fuel your success. Or some investors, of course, just won't be successful at all. And so if there's a common denominator in these stories today, it's that when people think about risk, they often think about what's going to happen to them. What is the stock market going to do to me? What is the economy going to do to me? I've often thought a better definition of risk is what we do to ourselves. Our own biases, our own emotions, anchoring to our own history. And that can be disheartening for investors to hear, that you are your own worst enemy in investing. I've often thought it's a pretty optimistic realization because you have no control over what the economy is going to do next. And you have no control over what the stock market's going to do next. The only thing you have control over in investing is your own behavior. And when you realize that the only thing you have control over is the most important aspect of investing, that's actually a pretty optimistic realization. And we're so lucky to live in an era these days when there are markets all over the world that are capable of generating big returns for ordinary people. And if we're not benefiting from that, if we're not taking advantage of that, it's often not because of what the market did to us, it's because of what we did to ourselves. And we have to remind ourselves often that people do not get what they want or what they expect from markets, they get what they deserve. Thanks very much.